Hi, my name is Marcus Stuhlman, and today I'll tell you about why I chose my company to invest. Okay, the companies I chose to go with are ExxonMobil, Home Depot, and Walmart and Chevron. My choice is ExxonMobil. Okay, first I'd like to talk about the liquidity ratios. The current ratio for ExxonMobil in 2012 is 1.005. The 5-year average is 1.08418, which means they can pay their obligations. The quick ratio is 0.6949 in 2012. The 5-year average is 0.7784. We are not in the best position, but we are looking to improve for the future. Okay, our cash ratio is 0.1494 in 2012, and our 5-year average is 0.25966. We will have a hard time paying short-term debt, but we are recovering from 2009, where we took a huge drop. For our tier ratio, we are currently at 157.8276. Our 5-year average is 136.71368. We dropped in 2009, dropped in 2012, but still is able to meet obligations. As you can see here, out of the 4 companies I was going with, ExxonMobil is second, Chevron is first. For our ROA, it's one of the main reasons why I picked this company. We have a 13.50 in 2012 and a 5-year average of 13.08528. And as you can see, out of the 4 companies, which is the blue line, ExxonMobil, we are the highest. Okay, and this is the ROE, the dew point analysis. First off, I would like to show you what I think is driving ROE is our asset turnover, and our asset turnover, the operating margin, and the interest burden. As you can see right here, as the interest burden increase and the asset turnover increase, we actually took a decline in 2012, but you can see the drop. Well, I think the asset turnover, the interest burden, and the operating margin is why our ROE increased. What's driving ROE? This is our ROE compared to the other 4 companies. We're a top 10 in the Dow 30, currently at 28.0273. Our total asset turnover, we're third in the Dow 30, currently at 1.2656. And that is one of our main components driving ROE, like I said before. And as you can see, we are third right here. Okay, and for our interest burden, we are currently at 157.8276. That is another component driving ROE. And we are first out of these 4 companies. For our operating margin, we are second compared to the other companies, as you can see right there. In 2012, we had an operating margin of 11.86, and that was the 3rd component to help drive ROE up. For our leverage, we actually did pretty good. We're not too high. We was at 2.076 in 2012. And our 5-year average is 2.06554. So we're right around, we stay right around the same average. Okay, and as you can see, they have 2 higher companies, the 2, Walmart and Home Depot, they have a higher leverage than us. Chevron is the only company with a lower leverage. Okay, our profit margin took a dip in 2009, but we have been recovering ever since then, and now is at 10.6676 in 2012. And as you can see, Right there, it took the dip in 2009, but we're recovering. Um, we're second compared to compared to Chevron, and we're way higher than Home Depot and Walmart. Okay, some of our growth rates compared to the industry and our sector in the S&P 500. As you can see right here, we went negative in our sales margin for the recent quarter. As you can see, negative 9.8. The industry was 9.7, but we actually did good in our earnings per share, which we are 11.4 for the market most recent quarter, and 15.2. And we're at 15.2 compared to the industry. We're at negative 116.6. So we're higher than our industry and S&P 500. We're just not higher than our sector. Our profitability ratios, our gross margin, as you can see right here, we are doing better than our sector, but compared to the industry, we have a little ways to catch up. Our operating margin, we're pretty close. Our asset turnover, we're doing better than everybody, as you can see. Our return on assets, we're doing better than everybody. Okay, for our market value, our price to book ratio, the low price to book ratio shows the stock could be undervalued. And as you can see, we are the second lowest. Home Depot and Walmart are above us. Our price to earnings ratio shows that investors are not expecting as much growth in the future compared to the other companies. As you can see, we are third. Home Depot and Walmart again are above us. For our economic value added, we added $2,518.11 in 2012. Our 5-year average is $6,453.75. And as you can see, we are second in economic value added. Walmart added more than us. And this is economic value added for 2013 for quarter one. As you can see, our equity is 97.1, and we only have a debt of 2.9%, which is good. And our capital charge, total invested capital, is $286,811,000, which gives us an economic value added for quarter one of $65,050,670. Okay, our risk, our beta is 14884, which means we have low risk. The company operates in a highly volatile environment, and earnings are heavily exposed to the commodity price risk. However, the market's risk, mainly price and interest rate risks, are offset by the corporation size, strong capital, and geographic diversity. Furthermore, Exxon maintains a high quality investment portfolio to help mitigate risk. Our dividend discount model, as you can see, our earnings per share for year one is $8.02. For year two is $8.20. For year three is $8.65. Our dividends per share for year one is $2.42. Our growth years is our growth years is 9. Transitional years is 8. Long-term growth rate of 4.38. And our closing price as of today is $88.21. Based on the values above, our theoretical price is $60.55. That is a percentage change of negative 31% from the closing price. Our internal rate of return is $8.63. Expected return is negative 10 almost 11%, and our applied growth rate is almost 9%. For our supply chain analysis, 71 suppliers, 18 customers, 21 competitors. Our top supplier is Floor Corp. We get 8.85% of our supplies from them, almost 9%. Our top customer is Tunisian Seki. You is our top customer, buying 24.09% of our goods, giving us a 1.92% in revenue. Some of our top competitors are BG Group, BP, and Chevron. Some of our current news is the company reported earnings of $9.5 billion in the first quarter of 2013 as compared to $9.45 billion for the same quarter last year. Exxon reported a year-over-year increase of 6% in earnings per share, hugely impressive in the current economic conditions. Exxon has announced plans to expand its production base, acquiring oil and gas fields in North America and Russia. As a result, we have seen a shift towards offshore drilling and shale plays. Exxon's decision will be hugely beneficial as it will mitigate the shortfall in production as well as meet the anticipated increase in demand due to an increase in the world population. Some more current news is Exxon pays quarterly dividends of $0.63 per share, yielding 2.8%. The company raised dividends by 21% recently. The payout ratio of the company did not exceed 50%, thereby providing growth as well as income earning opportunities to its investors. And that's why I chose that is an ExxonMobil.